All right, so welcome back, fail-safe investors and future fail-safe investors and future millionaires and billionaires of America or the world or wherever you're watching this video. So let's get right into it and let's go. Let's go. This is a video on how I pretty much go about finding growth stocks. So a lot of people ask me like, what's the stock that's I can buy right now and it's just gonna pop? And the honest answer is it depends on what do you find in a stock that you like, or what do you find in a stock that you think in the future might pop or something like that. But there are a couple factors that you can apply to a stock that you wouldn't apply to a normal stock, or a couple metrics that you can look at that you wouldn't apply to a normal value stock or an average stock like that. Like you wouldn't take Amazon and compare it against Coca-Cola, not just because they're in two different sectors, but you just wouldn't compare them because one is a value company and one is a growth company. So in this video, I'm pretty much going to walk you through how I find growth stocks. And the easiest way to do this video will be how I came about investing into Uber. So when I was looking at Uber, I couldn't analyze it like a normal stock. And I started to notice one common trend when I started to spot growth stocks or stuff like that. One is normally growth stocks won't pay a dividend. So if you look at companies like Uber, Tesla, Amazon, like I said, T-Mobile is a growth stock. They don't pay dividends because they pretty much reinvest all of their profits back into their company. Another thing that you might not notice in a growth stock is sometimes they either don't have a price to earnings ratio or they have a ridiculously high price to earnings ratio. So Uber doesn't have a price to earnings ratio. Tesla doesn't have a price to earnings ratio, even though the stock is selling for above $800 a share right now. And Amazon's price to earnings ratio is ridiculously high. It's like 89 or 90 or 100 and something like that. And if you look at the history of Amazon, now the company has always been profitable, but the price to earnings has always been through the roof. So when you look at Amazon's earnings per share, it was very small, but they were profitable when they started out, but their price to earnings has always been high. It's always been over a 30, and 30 is considered high. But at one point, Amazon's price to earnings was at like 1,000, and that's crazy, but it's still considered a growth company, and that was long before it was selling upwards of $2,000 a share. What made me invest in Uber is they're pretty much changing the industry, and that's what you want to look at when you're looking for a growth stock. You want to look at a company that's changing the industry that it's in. So when you look at Amazon, Amazon is pretty much changing the industry of how we shop. So it's affecting Walmart, it's affecting eBay and other e-commerce businesses like that. They can compete on prices, even their labor force, a lot of things like that. When you look at Tesla, they're disrupting the auto industry. Ford is selling for like $5 a share, and I still wouldn't recommend that you buy Ford. Even right now at $5 a share, I would still say that it's overvalued. Now, like I said, Tesla doesn't have an earnings per share. It doesn't have a price to earnings. A lot of analysts will say that Tesla is overvalued for the price that it's selling at, but a lot of analysts has also said that they can see this stock easily surpassing $1,000, and it was on its way to surpassing $1,000 before the big dip in the stock market in like March. Tesla's disrupting the auto industry, Amazon is disrupting the commerce industry, and Uber is pretty much disrupting the ride sharing industry. So they are disrupting the taxi industries, not just in America. So that was one reason for why I invested in Uber, because I felt like I was getting in on the ground level of this investment. They are disrupting all of the ride sharing industries around the world. And then when it comes to the ride sharing market, the total aggregated market in America, they have 61% of that market, and they are still growing. So that's another thing that you want to look at when you're looking at a growth company. You want to look at their revenues, like which I've mentioned in other videos. You can pretty much look at any brokerage account or any firm, Robinhood, whether you trade with Robinhood, TD Ameritrade, Charles Schwab, Fidelity like I do. All of these will offer like their earnings per share, their price to earnings. So all of that is like basic stock info that you find anywhere. Like even the Apple stock app will give you all that basic information and then news articles on that. Now you can take that a step further, and if you don't feel like logging in or creating a Fidelity account, you could always pretty much Google the name of the company that you're trying to look into and then type in investor relations page, And that's how I found a lot of my SEC filings, like the 10Ks, 10Qs, and things like that. They have the revenue filings on those pages, but that's also in the 10K. If you want to just look at that, it's easier. Everything's in one place. But I don't want to get off track here. So like I said, they got to be disrupting an industry. Also, their revenues got to be growing. And then another reason why I invested in the Uber is because of the management. Dara, I can't even pronounce his last name right now, but I watched interviews with this guy. I've seen how he operates his business. I've watched how he answers questions. He has a plan for the future, so that's also good, because a lot of companies I've looked at have no plan for the future. They have no way of getting to their goals. He has a plan that he's laid out, and he's executing. He said he want to be either first or second in any market that they operate in, or that you're going to get out, and he has done that. And then another reason what made me invest in Uber is like they are literally changing the game, which also contributes to like disrupting the industry. You have governors and senators in different states that are literally coming up with laws that are just tailored to Uber and Lyft alone, and Lyft is kind of like under the umbrella. Like they're pretty much targeting Uber, to say the least. Like New York has created multiple laws that are just for Uber. California passed a law where Uber has to list its employees, or should I say independent contractors, its drivers, as its employees, because Uber only lists 26,000 employees. So you have states coming up with laws. And then when Uber announced that they were pretty much trying to acquire or merge with Grubhub, the New York State lawmakers pretty much created a law like that. Now, Uber and Grubhub didn't merge. They weren't bought out by Uber or none of that yet. It's supposed to be in talks. It's supposed to happen. But it hasn't happened yet, and the law has already been created for that just alone. So New York pretty much put in a law that says, and it's already passed and went through, they pretty much put in a law that says that Uber, Grubhub, DoorDash can't raise its commission prices on its like food delivery services. So that alone has already affected them, and they haven't even merged yet. But if Uber and Grubhub decide to merge and they do come to some type of agreement and they become one company, they'll have like 60% of that market. They'll have 60% of the food delivery market, and then DoorDash will be second, and then Postmates will be third. Right now I think it's like DoorDash, Grubhub, Uber, and then Postmates is in like fourth place when it comes to like the food delivery market services, like the market shares that they hold. So that was pretty much what I looked at when I picked Uber as my growth company. And then another thing that you gotta look at is the institutional ownership. And that's not hard to find either. Those will be in like the SEC filings, or usually I find that on like Fidelity. They have a tab that says ownership, and you click on that and you can go to like institutional ownership. And that pretty much shows you what institutions have like what percentage of these companies. And so like Amazon, you have some big institutions in. Tesla, I haven't looked at personally, but I'm pretty sure that they have some big institutions in it. And the reason why I'm just assuming that they have big institutions is because big institutions, or big money, I should say, is what moves a stock up. So like just average Joe investors like you and I, we're not gonna pretty much invest enough to move a stock drastically. But when you have a lot of big institutions come in and start buying up shares, like mutual fund holders, pension fund holders, and those start buying up shares of your company, that's when you start to notice those big price jumps in your stock. So like with Uber, I think it was selling for like around 34, 33 bucks a share one day. And then like some pension fund out of Wisconsin came in and announced that they were buying up shares of Uber and selling shares of Apple. And that caused my stock to go up about $2 just in one day. So you want to look at that. And another reason why I invested in Uber was because of that, was because there aren't too many big institutions backing Uber other than SoftBank. And SoftBank is like based out of Japan. But SoftBank is pretty much its biggest contributor when it comes to like owning part of Uber shares and all of that. And then I think Toyota owns some shares, but that's it. So you don't have too many big institutions in it yet. Now I do believe once Uber becomes profitable, then you will have a lot of institutions coming in, like the pension fund holders, mutual fund holders, coming in and trying to get a piece of the pie. But that's why I decided to jump in right now on the floor level, and that's why I decided to make Uber my growth stock. I only have like one growth stock, and it's Uber right now. So like I said already, you're not gonna analyze your growth company the same way you analyze your value company like that. It's like you're just not. So like when you're analyzing your value company, you want your PE ratio to be low. You want like pretty much all your metrics to be low, meaning that the company's undervalued and you're pretty much buying at a margin of safety and it's not that much risk involved. Now, even though I have said that Uber is my growth stock, I have a lot of faith in Uber, it's still risky. But there are ways to eliminate the risk is by understanding the business model, how they make money, what goals they set for themselves. Are they accomplishing those goals? Does the CEO seem reputable? Like, do you like the CEO? All of that. So like, some people are buying Tesla because they believe in Elon Musk. Some people are buying Amazon because of Jeff Bezos. It all depends on what you like and what you understand about these companies. If you smoke cigarettes and you think Philip Morris is going to be a huge growth company or have growth in front of it, then go ahead and buy Philip Morris. Just do your research, understand how this business makes money. Like I said, the normal metrics for analyzing the company, you have to sometimes throw that out the window. But you have to know that if you are buying a growth company, they have to be doing something different. They have to be innovative. They have to be pretty much disrupting the market that they're in and have a huge market share in the market that they're in. And make sure, at least at the bottom line, at least that they're growing their revenues. So like Uber was making like $3 billion in revenue like 4 years ago, now they're up to like 14 billion. So make sure that that line is always constantly going up. And if you stick to that, pretty much I'm gonna say you can't go wrong with finding a growth company. Then I'm not gonna say they're easy to find, because finding a good growth company at, I'm gonna say like an affordable price, or at least the bottom, because even now at $800 and something a share for Tesla, that's still considered affordable for the growth that it has ahead of it. And once Tesla does complete its autonomous driving and they actually successfully have autonomous driving cars and they own that technology and they can do it and they start selling it, and then they have affordable fully electric cars, which they are trying to get to. They've cut the prices on their cars recently. I can see Tesla stock going up to thousands of dollars a share. So like I said, even at $800 a share, a lot of people will say that that is still affordable right now for them and they can buy it, because a lot of analysts predicted Tesla being at $12,000 or $1,200 a share by sometime this year in 2020. So it's all about what you like, what you find in your growth company that you like. At least understand the company, make sure that they're disrupting the industry, like I said, have a huge market share, and do your research. Just do extensive research. There is no such thing as knowing too much, because remember, this is you betting on this company. You don't come in at a game at halftime and bet on the team that's up. That's pretty much what I'm saying about how people follow trends. I'm just pretty much saying, don't follow a trend. Don't come in at halftime and say, oh, this team's up, I'm going to bet on them. Because if you ask me, I would not put my money in Zoom. That's just me personally. I wouldn't put my money in Zoom. Yes, it does have an extremely high price to earnings ratio, but that's not the only reason. The business model is too simple for me. And pretty much Facebook just introduced the same technology. FaceTime has that technology. They're not doing nothing new. So good luck on your future endeavors, and let's do it.